Good morning, good afternoon, everyone. It is a good day for a CNBC live stream. Not a great day if you are long in the markets, particularly tech. We're going to get into all of this. But first, let me say we're doing this in real time because we're seeing the NASDAQ down 2.3%. Rooney, this is about as big a sell-off as we've seen in the last little while. And we are heading back towards those lows. So to our audience, please get in your questions. We'll see them somehow, whether that's on YouTube or the Twitter feed. And we will ask them to Kate Rooney. And we're going to be talking to Dan Niles in about 5 minutes from now on that broader sell-off. But Kate, you are fresh back from your vacation. And since you've been gone, wow. What a plunge for Bitcoin, for the crypto space. Were you checking while you were on vacation, by the way?
I was, unfortunately. I couldn't resist. I do it every couple of days. It didn't move. It's funny. You kind of look at once a day, like, oh, it's at 40,000. In the meantime, it's up or down 10 or 15%. And if you only check about once a day or once every couple of days, you might miss some of the action. But I had a very long flight home and did a lot of catch up. So I have been talking to people today. But tough start for the year and one of its worst starts ever. I mean, it's only been around for a little over a decade, but really, really rough start if you compare it to what we saw last January, when it was sort of the start of that bull run we saw. Not looking good for Bitcoin right now, dipping below $40,000 this morning. And that really was a key psychological level as well. You have what are known as stop losses. A lot of traders sort of set that at $40,000, I'm told. So once it breached that level, we saw sort of a snowball effect. And this has happened, and that dynamic has played out a lot in Bitcoin, where you see one key support level broken and then sort of that liquidation event, although it does seem to have found support. I'll check it right now, but I think it's around.
Yeah, I think it jumped above 41K.
Yeah, exactly.
But that, we've had people like Mike Novogratz say that 40K was sort of that all-important level as you're talking about it. What's the next one? Is that 38,000? What are you hearing?
Yeah, 38 I'm hearing is sort of the floor that people are looking for. And it does seem to have found a little bit of support there. It fell to 39,000. But that level 38,000 is really seen as a support level. But that's the thing. The momentum-driven story is a big thing here. There's a lack of new buyers. So that's something we saw starting to play out in December. A lot of the new retail that got in around the high, 69,000. If you bought around then, you probably sold at the end of last year. And that's a dynamic we saw playing out in December, sort of a flesh out of all of these new retail buyers and a lack of new buyers right now. A lot of the activity going on right now, if you look at data from Glassnode, it is longer term holders that are making moves in the spot market. There's not a lot of retail action. And that's the reason it's sort of been stuck sideways for the past couple of weeks, despite some moves up and down. It's really been stuck in that mid $40,000 level, lack of new buyers right now.
So is it the whales then? Is that what you're saying, Kate? The ones that are selling right now, the ones that have this ability?
So the whales or just the long-term holders that have been in the market longer. They have a lower cost basis, so they might have gotten in around 20,000. They're not as eager to sell. So long-term meaning they've been in the market for more than 5 months. Those do tend to overlap with the Bitcoin whales, but they're not necessarily the same. So a whale is someone who owns more than $10 million worth. Those tend to be long-term buyers as well. So it's sort of a slight distinction. But the long-term guys are the ones who are saying, if you're going to hold this asset for a decade or longer, you're probably not as worried about a short-term move, whereas Bitcoin is just a less exciting, quick, volatile trade at this point. It's seen more as a sort of older school macro asset, and it's behaving like that and really trading.
Boomer coin, right? I'll never forget that phrase.
Exactly. Although some of the other altcoins.
Yeah, Ether, right? Ethereum is down 18% today. We have you get to some of these other coins, and we are seeing in this case, a much bigger sell-off in the current session and the last 7 days. Ether is down 18% versus 10% for Bitcoin.
Yeah, I was talking to Brian Kelly about that today as well, because it sort of hangs in between the really, really high growth assets like Solana and other altcoins that you've seen. It is sort of now becoming more institutionalized. Yeah, it's got futures markets, there's more leverage in general. And it's sort of halfway between Bitcoin, which really is trading like a macro asset, and some of these higher growth coins that trade alongside Bitcoin, but also have sort of decoupled from Bitcoin. You've got these new crypto traders who probably don't really look at what else is going on. They might not have exposure to some of the higher growth tech stocks and Apple, and they're not going to trade based on what's happening in the broader markets. They're crypto traders. They're working on Web3 and DeFi, and they're not as exposed to other assets. So Brian Kelly and I were talking this morning about sort of the decoupling between Bitcoin and the other markets and stock markets and equities versus some of the DeFi coins, and just that entire ecosystem tends to sort of be separate, although they are getting slammed today.
Right. Indiscriminate selling today. And we're going to get to other areas of the market. Kate, thank you so much. We'll have you on again very soon. Welcome back from vacation. I know that you'll be tracking all of the moves going forward. And it is exciting to watch, whether you think it's good or bad. Dan Niles, thank you for joining us. I just spoke to you on live TV. This is our first this kind of live stream, although we're not strangers to the digital live stream. Thanks for coming on. I think that there's so many people watching right now that are watching sort of this big movement in tech stocks that has continued since the end of last year. Let me get the first question from YouTube. When does the bleeding end? Can you answer that one?
Well, here's the thing. And so I've been doing this for a while, and I started my career on Wall Street in 1990. And in 2000, during the peak, I was on Wall Street, and the NASDAQ went down 79% over 2.5 years, and the S&P went down about 50%. And I remember this distinctly because the S&P had 7 distinct rallies of 15% over that 2.5 year period while losing 50%. So, and because like every 3 months or so, my traders, salespeople come in and go, "Oh, you missed the bottom. It's improving." And, and it would bounce up. The problem was after those 15% rallies, I think you had 8 declines of 19% apiece on the S&P. So this isn't going to be a straight line down, and there's going to be no bell marking the bottom. But remember, you've had 3 years where the S&P 500 over the last 3 calendar years went up 100%. And you've had a global pandemic for 2 of those.
Yeah.
So it really made no sense to begin with. And, I've been saying this for a while. It was really a combination of $5.5 trillion in stimulus that the government gave you, and then the Federal Reserve expanding their balance sheet by 10x on a daily basis. I mean, after the global financial crisis, their balance sheet went up by $3.2 trillion over 11.5 years. Then it went up $4.5 trillion in just a year and a half. So really what drove, whether it's Bitcoin, which we were talking about in that earlier segment, or if it's some people took that money and bought NFTs, others bought stocks, others bought real estate, cars, homes, that money found its way into inflating all kinds of different assets. And so when the bleeding stops is when you sort of found inflation kind of getting more under control and multiples at levels that make sense. And you're nowhere near either of those two yet.
So you think that there's a lot more room? Is that what you're saying, Dan?
Oh, yeah, absolutely. Because, if you look at it from a valuation standpoint, which is my favorite to give you an idea of how much risk you're taking on, which is what people have sort of forgotten, because the Fed sort of backstopped everything, and then the governments have backstopped everything. Your market cap for the entire stock market, defined by the Wilshire 5000, divided by the GDP of the U.S., is 1.9 times. At the peak of the tech bubble, it was 1.4. The 50-year average is 0.8. You could argue valuations need to come down another 50% before you get to average. That will more than offset the 20% earnings growth you see this year. And by the way, that's what happened in the 1970s, is you had a really strong EPS growth to start out, but multiples on the S&P went from 21 times to 7. And that absolutely crushed the market, and the market went down 50%, despite the fact that earnings growth was really strong during that early part of that decade. So that's, I think, unfortunately, what investors have to deal with. And, if you're a younger investor, you've been dealing with stimulus for 13 years. Yeah. You haven't had, you haven't gone through an actual prolonged downturn because every dip was met with buying because the Fed came in and saved you, or the government did.
And that's really helpful to sort of look at that historical perspective, Dan. This is something that you and I have talked a lot about in the past, though, or some of those deflationary forces and what could make the last few years different than any of the other years before it, right? You're talking about how we've seen the NASDAQ run up 100% because the world has changed in that time, right? We haven't had something like a pandemic and that digital transformation. At least that's what younger investors might argue or think. But you kind of say that, no, the 90s was similar to this. You did have the digital transformation of the internet, right? And you still had this sort of violent correction. So for younger investors, as you say, who've only known stimulus, who've only known, and a lot of investors got in during the pandemic, right, with stimulus checks. What would you tell them in terms of, countering the Cathie Wood argument that this is the fourth industrial revolution? This is bigger than anything that we've ever seen before.
Yeah, I mean, I listen to those arguments and I go, it's absolutely ridiculous. Because if you think about it, the internet just started in the late 90s and really got rolling. Amazon came public in the late 90s, et cetera. And early on, younger investors won't remember this, but Microsoft and Intel both were kind of poo-pooing the internet. And then they changed their minds and said, oh my God, this is a real thing. It's going to be big. And despite all of that happening, the NASDAQ went down 79%, 79, in 2.5 years from the peak in 2000 to the bottom in 2002. And over that 2-year period of time, Amazon's revenues doubled. But the stock went down from its peak in 99 from 106 to $6 at the bottom. And obviously, the internet was much more transformative 20 years ago than it is today. So it's not like, oh, we just discovered Amazon in the last 2 years.
At the same time, though, Dan, I mean, what characterized that time was pets.com, right? We don't have generally companies like that anymore. We have real
we absolutely
based
do.
on real earnings. Or do you think that things got so inflated?
No, we absolutely do have companies like that today. I mean, if you think about it, you've got, and I'll pick the electric vehicle space as an example.
I was going to go there, yes.
Yeah, you've got GM and Ford trading at 0.5 times EV to sales. Then you've got a Tesla, which has gone through the pain of what Elon Musk called production hell as he was ramping his Model 3. And that trades, though, not at 0.5, but it trades at about 13 times EV to sales or so. Meanwhile, you've got some of these newer electric vehicle companies that haven't gone through production hell.
Yeah.
And by the way, Elon Musk went through that when there was no COVID, there was no supply chain issues, and it was still tough. These new EV companies are trading at closer to 25 times sales, compared to a GM at 0.5 or a Ford roughly at 0.5 as well. So you've got all sorts of stocks massively overvalued. I mean, think about how many cryptos are in existence today. I will bet you 50% of them won't exist going out 2 to 3 years from now. Just like, by the way, in the internet, you had 4,000 companies go bankrupt over 2.5 years as the market finally found a bottom, and then you shook out the winners like Amazon.
So are you saying then that you are seeing kind of similar levels of froth as you did back then? And are you calling sort of the Rivians and the Lucids, are you drawing a comparison between them and pets.com?
Yeah, absolutely. You can draw a comparison between a lot of different cryptos, a lot of different EV companies, a lot of different non-fungible tokens. You can absolutely draw the same comparison because the valuations are much worse today. If you remember, I said
but they have sort of cars, and you say that Tesla was pulling all of this off in an environment where there was no COVID, but you could argue that these new EV companies are pulling it off when there's a lot more demand for electric vehicles and government support for them, right? So does that sort of offset?
Absolutely not, because I mean, you think back again to my Amazon analogy, e-commerce grew a tremendous amount when it first came out. Didn't stop Amazon stock from going down 95%. So that's the whole point. I mean, you look at Tesla, right? They pre-announced massive upside to their production numbers for the fourth quarter. The stock's absolutely gotten killed at the beginning of this year. And that has absolutely nothing to do with fundamentals. It has to do with the fact that the valuation was so high, which is the exact analogy I'm drawing to 20 years ago, except valuations today are much higher than they were at the peak of the tech bubble.
Right.
And you've got a lot of investors that haven't dealt with the prolonged downturn, which makes the situation that much worse. And the amount of money you have that's being pulled back is much higher than when the Fed increased their balance sheet, worried about Y2K crashing computer systems. So the setup now is actually quite a bit worse than it was in 2000 in terms of what you need to work your way through.
Could we see the NASDAQ fall by as much? Did you say it fell 79% from its peak back at the end of the dot-com boom? Could we see that?
Yeah, I mean, it went down 79% over 2.5 years with 7 massive rallies in between while it still continued to crater. And that's what people kind of forget if you don't go back and look at your history. Or the 1970s, honestly, it's an even better time to look at it, because inflation wasn't that bad during 2000.
Mm-hmm.
It was really bad in the 1970s, following the 1960s, where you had low inflation, good solid growth, stock market that absolutely ripped higher. Then you dealt with inflation in the early 70s, and the market went down 50% over 2 years between the peak in 1972 and 1974, the bottom. That's more the analogy you probably need to look at, because in a high inflationary environment, that's the closest analog to today, even more so than 2000, you can argue.
So today, though, we have these sort of mega cap tech names that are supporting, the tech sector somewhat more than perhaps back in the previous periods. Do you think NASDAQ is about 6% or so off its record? Do you think that we can see a fall off of more than 20%, 30, 40? Where do you put that level?
Well, I mean, if you remember when I think I was on your show, I think in late December, and we were doing our top 5 picks, I said I fully believe the S&P is down 20% at some point this year. And NASDAQ I disliked even more, because the valuations are highest in the NASDAQ for names that don't have any earnings for 5 to 10 years out. So yeah, absolutely, you could see a drop of more than 20% in the NASDAQ this year. That's pretty easy to see.
Now, I want to talk about some of the investors that got in during the pandemic, right? I know a few of them who bought Zoom and Peloton and DocuSign, all of these high growth names that saw huge gains in 2020, but have had a really hard time. What do they do? Do you think that they hold on because these have come off 40, 50, 60% off those highs? Or is there still time to get out of those names if you think that there's further downfall? What do you do to an investor that's only gotten into this market in the last few years and was picking individual stocks?
Yeah, I mean, I think here's the thing, like on a day like today, would I be selling? Absolutely not. Because the market, you're going to have somebody come in tomorrow and say, oh, it's a buying opportunity. And who knows, maybe it'll go up. And on the high volatility names, whether it's a crypto asset you own or an electric vehicle company, or, you pick your favorite, you can see a 10% bounce, the day after you see a 10% drop, because these markets never go straight down. And there will always be somebody who's going buy the dip, have fear of missing out. There is no alternative, all the nice catchphrases before. But I think if you step back a lot and you say, well, how much money have I made over this period of time? And is whatever I'm holding generating cash flow, generating earnings, and is going to be around, 3 to 5 years from now, because they do have that cash flow to survive a prolonged downturn. Those were the companies that made it through the bust in 2000. It makes it a lot easier. Otherwise, I would say, take some money off the table. You've probably made a tremendous amount over the last 3 years. This is not even a drop, quite honestly, in the market. I mean, you look at NASDAQ, it's down, S&P is down 5% from its 52-week high. NASDAQ's down 10%. That's absolutely nothing in the sense of if you look back through history. So there's a lot more that can go wrong. And, I said this before, people view cash as a terrible investment. It's not a bad investment in an environment like this, unless you're comfortable being short, because it gives you a chance to buy great stocks much cheaper, and as they've matured over a period of time, which is also important.
Yeah, you said that. It's one of. Did you say it was your top holding this year? I know I saw it's in your top 5, but cash.
Yeah, no, it was a top 5 pick, and as I said, it's my favorite holding.
Your
because,
favorite.
Because cash is the only thing that you go, all right, it's stable. I mean, obviously, if you can, we have, as many shorts almost as longs that we have in the portfolio. Yeah. If you're sophisticated enough to do that and are willing to manage your short positions daily, which you need to do, then that's, even better, arguably, to hedge your longs if you're going to have them. And so that's the way I would think about it.
Dan, one thing I love about these live streams is that we get comments in real time, and I can see the YouTube feed pushing back on your NASDAQ thesis. Someone says it's 1,000% different today, which is sort of what I was trying to get at in terms of the mega caps holding it up, holding support, and maybe the quality of some of the companies. What do you say to that?
Well, you should go back and look at 2000. Cisco was the most valuable company in the market back then. It was tech that was driving 2000 as well. And when you want to get involved in trends is early, not late. The internet has been around for 20 years. A lot of these trends have been around for a long period of time. that's why, if you think things are way different today, it doesn't even make any sense to me, because Amazon existed for a very long time. Video conferencing has existed for a very long time. Bitcoin has been around for a very long, not as long, obviously, but for a decade. So it's not like these things are brand new. And all COVID did was it accelerated those trends. But think about it. Netflix has missed 2 out of 3 quarters of subscribers after a big surge the year before driven by COVID. Amazon missed massively. Their EPS per share, I think, went from $19 a share in March to, I think, $6 a share September, if I'm remembering correctly, during this pandemic. You've seen what's happened with Peloton. DocuSign, which was supposed to make this through this fine, went down 42% after they reported. So all it did was accelerated a lot of trends that were already in the market. Now you're trying to find the normalization point of that as people are going to the theaters to watch Spider-Man, which I'm looking forward to doing, instead of staying at home and streaming it. So things are kind of shifting around. So yeah, it's 1,000% different today than 20 years ago, because these trends have been around for a lot longer, whereas 20 years ago, a lot of them were in their infancy. So they were more impactful.
Well, Dan, I hope you get to go see Spider-Man in theaters, and I hope you get to take that vacation next year too, right?
I'm going to be taking it.
Not the Peloton. I wish we had more time. There were so many questions. Really quickly, because this was a really interesting one, really briefly, do you loop in Chinese tech, or is there an opportunity because it has fallen so much?
Yeah, I mean, Chinese tech, the problem is this. I mean, making money in markets is hard enough. When you're fighting a government to make money, which is what you're doing, because the regulations, like every time you think maybe we're getting to the end of this, the government comes out with more regulations, more issues. So what I'm doing is I'm actually trying to pick away at Asian tech that's non-Chinese right now, because a lot of those stocks have gone clobbered along with Chinese technology, because those are the biggest, market cap names outside of the US in tech. So that's actually where I'm going and looking for things in places like Africa, Middle East, et cetera, other areas, Korea, outside of China itself. Those stocks have gotten murdered too. So I think there's some interesting things there potentially.
Okay. Well, Dan, thank you so much. Doubleheader today on TechCheck, the show, TechCheck, the live stream. We'll do it again soon. Thank you so much, and talk to you soon.
All right. My pleasure, Deirdre. Take care.